As we discussed in the last episode, the dot-com crash in 2000 was catastrophic for tech companies and their investors. But they weren't the only casualties during this period. The subsequent terrorist attacks and corporate scandals left lots of businesses in trouble, and with risk aversion high and financing once again impossible to obtain, the leveraged buyout business was in limbo too. But here's the thing. Those same buyout firms who were sitting on the sidelines during the tech mania were now sitting on the piles of cash they didn't deploy. Well, the smart ones were anyway. And they're in the enviable position of being able to supply capital at a time when capital was scarce. And they begin buying up the debt of financially distressed companies at bargain prices. The goal was to amass a large enough position in the debt to force a restructuring of the company, at the end of which their debt would be converted into equity. This type of private equity strategy is called distressed debt investing, and its emergence reflects the opportunistic nature of these firms. When the world is fearful, those brave and smart enough to invest can reap great rewards. And they did. In 2004 and 2005, after the stock market begins to soar once again, firms begin cashing out huge gains on those investments. And as the cycle goes, this gets the attention of investors who are becoming more and more risk tolerant and hungry for high returns. Add this to the return of credit on an unparalleled scale, and you get something called the golden age of private equity, and the return of the leveraged buyout on a scale not seen since the 1980s. This time, it's the VCs who are taking a back seat while buyout investment reaches historic highs in 2005, 2006, and again in 2007, and becomes a powerful force in the economy in a way it never had before. Hundreds of billions of dollars are being raised by the new kings of capital, with Blackstone setting the all-time record at $22 billion for the fund it raised in 2007. But Steve Schwarzman, founder of Blackstone, doesn't stop there. He does something else unprecedented. He takes Blackstone public, the first private equity firm ever to be taken public. And at the end of the first day of trading, he's worth $10 billion. And if this isn't a sign of the times, I don't know what is. But Steve does not get the award for largest leveraged buyout deal ever. That once again goes to KKR when they buy energy giant TXU for $45 billion, which finally surpasses their RJR Nabisco deal from the 80s. But actually close behind is Hilton Hotels, which Blackstone does close, just before the credit markets freeze and the global financial crisis ensues.
The global financial crisis affected the entire global economy. No sector was spared. It was the worst downturn since the Great Depression. Pundits claimed that private equity was doomed because of the massive prices paid and the massive amounts of debt on their companies acquired during the golden age of private equity. However, a hero emerged. Ben Bernanke and the Federal Reserve launched unprecedented monetary stimulus to save the U.S. economy and financial system. Once again, private equity had massive amounts of capital to invest from record-breaking fundraising years in 2006 and 2007. Private equity became a source of much-needed capital during the downturn, and distressed debt investments became common again, and the best private equity managers capitalized on the situation. And gradually, the credit markets reopened, which allowed private equity to refinance the massive amounts of debt on their portfolio companies acquired during the golden age. And eventually, a bull market in stocks led to record M&A and a flood of exits for private equity. By the way, that Hilton deal that we mentioned became one of the best private equity deals of all time. With record distributions, investors redeployed that capital back into private equity. And in 2015, we saw the best environment for private equity fundraising ever. That brings us to today. 7 years from the global financial crisis, asset prices are near record highs, leverage is at record highs, and venture capital is back with unicorns. A unicorn is a venture capital-backed company valued in excess of $1 billion. Once rare, in 2015, according to Fortune, there was over 80 of these kind of companies. So if we are at a potential peak of cycle number 4, why would you invest in private equity now? Tune in to a next episode to find out.